Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts and Chat for October 17th of 2022. Share a disclaimer for important information. Well, as we start to chart back this week, we want to focus on inflation. We got some really recent inflation data here for the survey for September, and you can see here both that the Consumer Price Index CPI as well as a core CPI. It turned out to be a little bit hotter than expected. Now, granted, overall inflation is coming down off of its peak. It's just not coming down at a pace which I think would have placated the market had it been a faster rate of decline, or if it had come in on the expectation numbers. But as it is, inflation remains kind of persnickety high, and so this obviously gives more injection into the arm of the Fed to continue to raise interest rates. And so these numbers right here have added considerably to the volatility over the last week in the investment markets, and it's really because these numbers are not coming down at a fast enough pace. And so the feeling is the Fed is going to continue raising rates, thereby likely inducing some type of a recession over the next 6 months or so. I think that's a reasonable expectation right now. So now we're really in the mode of kind of trying to prepare portfolios to weather this storm so that we can get to the next market upcycle, which a lot of people aren't focusing on yet. But these things are inherently cyclical. Recessions are never a question of if, but rather a question of when. And oftentimes they happen because the Fed is trying to make up lost ground, as they are right now, and trying to fight this inflation bug, which we know from a historical standpoint that Fed actions that happen today will generally filter into the economy about 6 months from now. And so again, I look for slowness. I do look for inflation to come down. There's areas of inflation that are going to remain very sticky, rents and wages being two of those. So again, we'll watch these numbers, but this is the main contributor over the most recent volatility in the market. So as we see these numbers on a year-over-year basis, you can look at the survey on the left. What we just showed you was the monthly numbers, and this is the year-over-year numbers. About 6.5% was a survey, came in at 6.6. Again, not a material difference, but yet it was higher than expected and caught people a little bit off guard. Now, if you look at where this is coming from, a lot of it has to do with services. Now, we've seen goods inflation kind of pass through the economy, and now that's not the biggest bugaboo. It's the service side. You can see that on the right-hand side. Those readings remain relatively high, and so we do want to watch those numbers and be cognizant of the trends there, because you can see service inflation, after having lagged goods inflation for a while, is really caught up. Here's a high frequency data from our friends at First Trust. And again, this is part of this conundrum, because you look down this table, you can see that the labor data is actually very strong, continues to be very strong. Labor market's pretty tight. There's more openings than there are unemployed people to fill them, even though some of these staffing numbers seem to be curtailing a little bit. And we see the ASA staffing index still strong month over month, but weakening just slightly here in the week. Change versus 2019, obviously very strong. You still have some of these areas like TSA checkpoints, motor supply, motor gasoline relative to pre-pandemic levels, not quite there, but really the only area where we see some softening in some of the key data that we tend to track more often here is motor gasoline, and that has a lot to do with prices moving back up a little bit after having come down consistently for so long. But if you put that in check and you look at TSA checkpoint data, again, a change versus 2019 still negative, but month over month, pretty strong. Open table, pretty strong, really. Not the kind of numbers that you'd be looking at if you were literally on the eve of recession. Here is the staffing index, looking at the number in that kind of that aqua green or aqua blue number, perhaps. You can see where we are relative to the last several years. Again, in a fairly decent, strong and decent position overall. Weekly retail sales, though, you can see the impact of a little bit of demand destruction. You see the impact of people dipping into their savings and maybe putting more on credit cards. But you can see retail sales relative to a year ago are clearly trailing off. Just as on the one hand, you see staffing and employment high, you see retail sales kind of trailing off a little bit. So you're getting kind of conflicting signals, if you will, with regard to the health of the market. But I think the pace at which retail sales is dropping off is certainly symptomatic of a broader trend. Again, I think it's a good thing in response to the Fed raising rates. This is one of the things that the Fed's going to be looking at in making its determination as far as future rate increases go. If they can not kill, but if they can curb demand, which is one of the policy tools that they have, if they can curb demand, that helps them drive inflation lower. Now here's a chart that probably speaks as loud as anything that I've shown in the chart pack over the last month or so. I think this really tells a story of what's going on in 2022. It's a dispersion plot of bond returns in the y-axis versus stock returns in the x-axis. And so, you can see, if you look at it in the upper right-hand quadrant, those are years in which you're having positive bond returns and positive stock returns. And again, that's most of the time. Every once in a while, you get a positive stock return, and you get a negative bond return. That actually happened last year. Stocks were up considerably, but bonds were down. And then in the upper left-hand quadrant are periods where the stock market's down, but you're getting the benefits of diversification because bond returns are up. And so you look at this matrix, and it's clear that if stocks and bonds aren't going up together, then more often than not, you're getting one that's performing the opposite from the other. And that means they're less correlated, right? If stocks are up, bonds are down, and vice versa. And in the lower left-hand quadrant here represents the 3 years, 1931, 1969, and 2022, in which both stock and bond returns are down. And you can see, where we are in terms of bond returns. We've never had a year which we've seen such an erosion in bond returns. We're down, actually, technically speaking, in the aggregate, we're down about 16% right now. And then obviously we're down around 25% in S&P 500. And so, this is such an odd year, very odd. You look at this, only going back to 1926, there's only been 3 years where we've had this issue that's happening this year with stocks and bonds having negative returns. And the degree to which that they are negative is also fairly outstanding in terms of its lack of occurrence. So I just want to, emphasize how difficult a year it has been for money managers to manage wealth in this environment where you don't have those traditional offsets that you do. Even gold is down 11% for the year. And so this is a pretty profound chart. It just shows you the difficulty that we're facing in portfolios this year. Again, it happens, and this is I'd say this is a one, obviously this is essentially a 3 in 100 occurrence here, but and so it's extremely rare. But usually when you have years like this, the following year is exceptionally strong. Here's a relatively busy chart from Charlie Bolello showing you bear markets on the S&P 500. And bear markets are defined by 20% drop from the peak. You can see all of these going back to, like, say, 1932 and the percent change. And so from January 2022, it's highlighted in the blue up above, through October, we've got a 9-month bear market. And we don't know about the recession yet. We don't think that we've been in one. We think that we're close to one. So we can't really call that yet. But we're about 28% down, peak to trough. Again, just like that last chart showed you. We haven't had any help from bonds. We haven't had any help from gold, and frankly, we had a little bit of benefit from commodities early in the year, but then that even kind of trailed off. But so we're down 28% peak to present. But if you take the median of all of these bear markets, the average or the median length of bear market in terms of month is 12. And the average drop is 29%. Now, again, if we have a recession, then that may fall. There's a possibility another 5% or so fall in the market before it picks back up. But when you have a recession, it tends to last a little bit longer. But again, if I'm close to being right in my assessment here, then we've got another 6 months of this, and that puts us in kind of a 15-month range. And if we are a little bit soggy in the equity markets before we move back up, then that's pretty much consistent, right in line with these averages going back to 1929. Stocks tend to rise modestly during tightening cycles. This is the other thing that confounds us, because when we're sitting here in February on the precipice of a rate increase, of course, at the same time we had Russia invade Ukraine, but usually you do get stocks to perform once you get the relief of knowing that you've got the first tightening in interest rates behind you, and that just didn't happen this year. I think stocks wanted to rally, but we had so many things. China was locking down. We had a lot of inflationary acceleration at that time, and so it just got the market in a real tight and anxious position. So we didn't have that this year, but by and large, it actually does happen when we have tightening cycles. Here's a quick look at food prices. And so, you always try to look for the silver lining in things. So you've got the United Nations Food Price Index, which is advanced 8 months here. And you see that in kind of that brighter green here. And so that, it still remains high relative to history in terms of the annual rate of change. And that is on the right-hand scale. So, we've decelerated, if you will. We're still positive year-over-year change, but it is rolling over. So that's a positive sign. And the CPI number for food, which has been extraordinarily high, and that's on the left-hand scale. We know that's above 10%. But, if you look at the pretty tight correlation here in these two, it would seem to reason that you're going to get a rolling over in food-related inflation fairly soon. Here's rents. We know that rents tend to be a little bit sticky, but we are seeing some erosion in the single-family sales market. We are also seeing a little bit of interesting dynamics in the multifamily market. And so, here these numbers from Zillow and Apartment List are highlighting the fact that on a monthly percentage change, the rate of gain for rents is actually decelerating. Again, these are big contributors to the CPI. I'm not suggesting here that we're going to have negative influence from these. I'm just saying that they're slowing down. And so the influence on monthly inflation should begin to, or in fact already begin to wane a little bit. So we look into the next 3 to 4 months worth of data, certainly getting into 2023, this picture overall should look a little bit better. Here's job opening rates, and then the Atlanta Fed wage growth tracker on the left-hand side. You can see it's a positive relationship here. And so, we've had job openings rate roll over. As I mentioned, things are softening up a little bit, but there's still more openings than there are unemployed people. Wage growth we still see is moving higher overall. We're not back to pre-pandemic levels, at least from the Fed's definition of wages. That's on the right-hand scale. But then, if you look at, wages, just in aggregate, they have certainly accelerated. And again, you can see this depicted two different ways on the left and the right-hand scale. ISM manufacturing, this is looking at inflation, looking at manufacturing's influence into end inflation at the consumer level. You can see here that ISM manufacturing, and this is an advanced scale. So this is like a leading indicator. And, look at this relationship with consumer price inflation on the right-hand scale. CPI is pretty high, just as we were talking about food prices rolling over on the United Nations number. I mean, we're looking at ISM manufacturing prices paid index rolling over clearly in this data. And so that should bring CPI inflation down with it, because these two traditionally have a pretty tight relationship. Excess demand for labor. Again, we talk about the labor market being fairly strong. We haven't seen this kind of excess demand for labor in over half a century. So even with job openings moving lower, there's still a fairly strong demand for labor out there, and frankly, jobs that cannot be filled, and lost productivity because workers cannot be sourced. So this is a problem. You look on that gap number down below, and it will tell you that we're in an extraordinary period. That this is something that you typically don't associate with recessions too highly. If you have demand for labor, obviously people feel good about their prospects, or they anticipate increased demand, and so they're trying to hire in front of it. Sharp decline in job openings, and this is something else that is just runs afoul of common sense here, is that you have job openings decline, but you have rising payrolls at the same time. So job openings are again, they're still pretty strong. So don't get me wrong. I mean, the labor market's still relatively strong, and you have rising payrolls, and we saw that in the wage numbers a few slides ago. But it is interesting to watch a sharp decline in openings when you have this rising payroll environment. Oh, a couple of random things here that I saw was kind of interesting. You've got developing nations, and you haven't really been talking about a lot of debt stress and a lot of sovereign debt stress. I mean, we haven't talked about that in years. But yet seems to be, as we get into 2022, where the black shaded area here are those developing nations that are in or at high risk, rather, of debt stress. You can see that number has gradually been increasing, but the key thing to note here is it wasn't catalyzed, if you will, with the pandemic. This is already a trend that's been in motion. Back in 2008, 2009, that was clearly an issue, and we even had the emergence of this as a topic back in 2016, 2017. But you can see it take a little bit greater hold right now. But again, not something that happened overnight. This has been going on for years. Job openings to unemployed person by industry, which I thought was particularly insightful. This goes back to a couple charts ago. I didn't really sequence them as well as I should have this week, but anyway, I thought this was pretty interesting because you can see peak labor demand. You've got professional and business services, education, health, financial services, information technology, and government, and then current labor demand. So that's you're looking at the gray bar is peak labor demand since the shutdown. And then the blue represents where it is right now as of August. So this is a lagging indicator. This is data that gets reported when you get it, right? And so the average since December 2000, so this goes back 22 years more or less, and you can see that the current labor demand in all of these sectors exceeds, and by the greatest amount in financial services and professional and business services. But in all areas, labor demand currently exceeds the average. Going back 22 years. Again, strong labor market. Post-tax corporate profits. This is something else that you typically don't see if you're like really talking about recession. You got essentially after-tax corporate profit rates still continue to move high. You got corporate taxes that are lower. People are finding ways around that. Obviously, we've had a lot of discussion around a corporate minimum tax that really wouldn't hit, but the ultra large, essentially the Fortune 100 type companies. But this is, again, something you don't associate with a recession is high margins. Now, the average consumer is apt to feel a little bit of a pinch from utility bills heading into the end of the year. 25-year high electricity prices. This is out of the U.S. Energy Administration. Apparently, this is, I believe, their fourth quarter forecast, and so you can see that year over year. Obviously, in certain parts of the country, like here, where we had the ice storm and the big snowstorm that shut things down for a while. And a lot of people had to make like spot repairs and are now passing those surcharges through the municipalities back to consumers. And it's hitting them at a time where overall inflation is relatively high. And so this is a chart that kind of shows you, okay, well, just when you think that you've got mitigating impacts on inflation, that you've got this that kind of helps to make it sticky. And this is one of those kind of, I call them real inflation measures, where because people open up their utility bills and it looks higher to them. It's not one of these things that you just kind of like you pay for the same thing every week and you don't really tend to notice a change until you wake up one morning. It's like, wait a minute, I'm paying a lot more than what I used to. Well, this is something that you see absolutely on a month-over-month basis, especially during the summer down here in these parts. Commodity super cycles. So we've been talking about how commodities have been a little sluggish this year. We came off, relatively and unusually rapid price increases for a lot of commodities, both in the ag sector as well as the metals, industrial metals especially. But here's a depiction, and this is something we've been talking about for a while. And this is one reason why we haven't gotten rid of our commodities, even though they've been a little soft. But usually when you have these breakouts, and this has been studied a lot, that you tend to have long-term uptrends, and you have consolidation phases. And we've been in a consolidating phase for, I'd call it a number of years. For as long as we were, in this prior bull market, we were essentially in a consolidation commodity phase. But usually when you break out of that range and you kind of like hit your old peaks and surpass those, you tend to hit a commodity, what they call a super cycle, which is several years of absolutely strong and resurgent growth in commodities. And so that's, I think, where we are now. Again, we'll obviously look back in a year or so and see if that premonition was correct. But the chart here is fairly clear in its interpretation that once you break through that prior high earlier in a consolidation phase, that you tend to continue to move higher. Here's central banks moving at a really rapid rate. So again, you've got the U.S., which we know, well advertised, are moving pretty fast. But you've got developed market central banks that are also raising rates to try to keep up in response to the strength of the dollar, because obviously the U.S. keeps raising rates, the dollar is going to keep getting stronger, and it's going to make these other currencies weaker and less competitive. And essentially, these foreign central banks are trying to prevent the debasing of their currency by moving in tandem with rate increases, even though they may not be as prudent as they certainly are here in the States. And right here, it's clear in this chart, we've had over 1,500 basis points of collective tightening in a very short period of time. Here's the U.S. PPI. Again, something else. I kind of intersperse these to kind of maybe hopefully give us a little bit better feeling when we think about inflation. This is producer inflation, and we saw the chart earlier where manufacturing inflation or prices paid is rolling over, and that's pretty tightly correlated with CPI. Well, here's the purchasing price index, the PPI, and you can see while it's still high and really high relative to prior cycles, it's clear here that we're at a 14-month low in overall PPI. S&P 500 PE ratio excluding the FAAMG stocks, and you can see those defined below: Apple, Amazon, Microsoft, Facebook, and Google. We were talking about those a couple of years ago because they were the ones driving the entire market. The market breadth was actually pretty terrible in 2020 during the summer, and these technology stocks were really driving the boat. Well, they've taken it as hard as they've gone up. The more they've taken it on the chin here, and as of late, and it's actually had a pretty big influence when you look at the overall breadth of the decline and the fact that these FAANG stocks have really taken it more so on the chin than other areas of the market. You see that the PE ratio, price to earnings ratio, if you exclude those high flyers, what we call long duration stocks, the multiple on the market is actually pretty low. Here's a quick look at China, a little bit busy. This is actually from the World Economic Outlook. So, we've had some updates in the IMF data, International Monetary Fund, as well as World Economic Forum, the WEO, World Economic Outlook. So China, consensus forecasts are continuing to fall. I think there's a pretty strong consensus out there. China's faced quite a few headwinds related to its self-induced shutdowns amidst the global economy. So we know global trade and global demand is waning, and that's obviously not necessarily good, for China. But what's interesting is the U.S. has a large net trade deficit with China, but in many respects, China has a large trade deficit with the rest of the world. And when domestic consumption slows down, then you've got a real problem in China, and that's what you've got right now. You see real estate indicators weak, growth forecasts coming down for both the 2022 as a whole, as well as certainly for 2023. This is a measure of Treasury volatility. So this is essentially a kind of a VIX indicator, if you will, for Treasury bonds. And you can see that volatility in fixed income overall is at a fever's pitch right now. I mean, we thought it was high in the summer, but it's reattained those peaks. And so it just goes to show you the difficulty of this market. Not only do you have equity market volatility, but you absolutely have fixed income market volatility as well. And that's traditionally not what you see in this environment. Here's a relative strength indicator, U.S. equities relative to bonds. And so what this tells us, again, almost in light of what I just mentioned, is that you've got equities that are increasingly oversold relative to bonds by this indicator. That bonds may not be, necessarily, of tremendous value right now, but it depends on where you think rates are going to go. If you feel like rates are going to crest in the next 6 months and then maybe even go down in response to a recession, and generally if you have that, then you're going to have equities responding positively in response to that, because equities and PE ratios actually tend to move well before you exit a recession, as people anticipate that next market environment. And I think that's probably what's going to happen next year. But right now here, on a relative basis, equities are much more oversold in this environment than we see on the fixed income side. That's all we got in the chart pack this week. Hope you've enjoyed it. Feel free to send us a question. Glad to answer it. Have a great week, safe week. We'll talk to you again soon. Take care. Bye.